Good evening, everyone, and a warm welcome to Bursa Malaysia DCE Soybean Oil Futures webinar. We are delighted to have you here with us today. So, before we get started, please confirm that you can hear my voice clearly by typing yes or share an emoticon in the chat box. And if you are able to listen to me clearly, you can type in yes or put an emoticon in the chat box. Great, thank you very much. Well, I'm not quite sure whether you are aware that Bursa Malaysia is going to introduce a new commodity futures contract and will be launch this new product pretty soon, which is the reason why today we are having this special webinar so that you can have a brief understanding about this new DCE soybean oil futures contract, in short, what we call as the FSOY. And you will also be discover what are the trading opportunities available for you. Our topic for today is trading strategies for soybean oil in the Malaysia market, which I believe this is something new and interesting to you. This webinar is proudly brought to you by Bursa Malaysia in collaboration with our company Axcelearn. My name is CY Saw. I will be the moderator for today's webinar session. We are privileged to have two speakers with us here today, Susan Low and Wong Hao. They will be sharing with us this informative session about the Bursa Malaysia DCE Soybean Oil Futures Contract, the FSOY. I noticed some of you here just entered this webinar. Now, before we begin, let's perform a quick audio check one more time, alright? Please type in OK or yes in the chat box or give us a thumbs up to confirm that you can hear me clearly. And if needed, please adjust your volume settings to ensure optimal sound quality. Alright, great. And also, to ensure the smoothest and highest quality video experience on your side, I highly suggest that you turn off your video camera during the session, as this will ensure that everyone can enjoy uninterrupted video and audio and have an optimal learning experience. Our webinar session for today will be divided into three parts. The first part will be presented by Susan Low. Following that, the second part will be presented by Mr. Wong Hao. Then we will be opening up for a Q&A session where you can ask any questions that is related to today's topic. And to ensure we can address your question, kindly type them in the Q&A box and send them to all co-hosts, as this will allow me to directly assess your questions easily. And please note that due to the volume of message in the chat box, it may be challenging to spot your questions if you don't send your question in the Q&A box. So along the way, if you have any question, you can type your question in the Q&A box. Great, it looks like we are all set and ready to go. Before we begin, it's my pleasure to introduce you our first speaker for today, Susan Low. Susan is currently the Manager of Commodity Product and Market Development at Bursa Malaysia Derivatives. She is responsible for improving and expanding the commodity product offerings for the exchange. Besides that, Susan also has an extensive experience in the derivatives market. Without further ado, I'm delighted to hand over the presentation to Susan. Susan, there you go.
I'll be starting with an introduction to the Bursa Malaysia DCE Soybean Oil Futures. In short, we call it FSOY. So first of all, what is the FSOY contract and when it is expected to launch? The FSOY contract is a futures contract license from DCE, using its crude soybean oil with the quality standards specified in the soybean oil futures contract of DCE as its underlying asset, which means the underlying of FSOY is using the same underlying asset as DCE's soybean oil futures, same in the contract specs. And FSOY will be using DCE soybean oil futures final settlement price as a basis to calculate FSOY's final settlement price. However, take note that DCE's final settlement price is in Chinese yuan as per this, the blue diagram in the middle. So DCE, when it settles, it is trading and settles in the Chinese yuan. But when for FSOY, FSOY is US dollar denominated. So we will take the DCE soybean oil's final settlement price in yuan and convert it to US dollar to become FSOY's final settlement price. And for the launch date, it is expected to launch on 18 March 2024. And we have gotten the approvals. And so this is the target launch will remain on this date. So stay tuned. It will be 1 month later, the product will be launched. So here's a calculation example of how this final settlement price works. Take the DCE soybean futures September contract 2023 as a study case. These are all actual data. So DCE soybean oil September contract expires on 14 September 2023. So on this day, you will get the final settlement price of this contract. So the final settlement price is Chinese yuan 8,732. So how to convert it to US dollar? We are using the CNY Central Parity Rate on the final settlement day of this DCE soybean futures, which the rate is on that day is at 7.1874. And now we use this rate to convert to US dollar, which we are getting 1,214.9. So as FSOY, it is the pricing, the minimum fluctuation is 0.25 US dollar. So we'll round up to become 1,215 US dollars. So this will be the final settlement price for FSOY. So this is how it works. Next, why we launch FSOY. So this is the very exciting product that we are launching this year, and it comes with a lot of benefits for the market as a whole. So in DC's market, DC holds the world's most actively traded crude soybean oil futures. It is currently the soybean oil futures with the highest liquidity, highest volume, and many traders would like to participate in this market. It's very huge. While for BMD, we have the world's most actively traded crude palm oil futures. So with this combination, we are taking the DCE's soybean oil futures, license their futures, and then put it on the BMD to trade, settling with their final settlement price convert to US dollar, means our traders will have the benefit to access to the Chinese soybean oil pricing in one exchange, which is on BMD. And comparing the palm oil and soybean oil is a standard business practice, as these two commodities are substitutes in many applications. So many traders are actually using comparing the prices of palm oil and soybean oil and create spread strategies, or they are using palm oil or soybean oil for the same business purpose, which is why having both commodities in the BMD allows the trader to capture the arbitrage opportunity effectively. They can do spread trading on the same exchange. So it is very easily and it is more effective to trade both contracts, create spread strategies, and monitor the pricing of both contracts if it's on the same exchange. At the same time, enjoy some margin credit from intercommodity spreads trading. So later, Mr. Kon Hao will be sharing some of his observations and trading strategies on this palm oil and soybean oil spread as well. So very looking forward to Kon Hao's sharing. With this, the pricing of FSOY, as it's using DCE's final settlement price to settle the contract, it will be nearest to China's soybean oil pricing, which the physical players exporting the soybean products to China can hedge the price risk with FSOY as an alternative option to DC's soybean futures. So this creates an alternative avenue for international traders to access to the Chinese soybean oil pricing. Next, let's look at the contract specifications. Yeah, the full name of this FSOY contract is Bursa Malaysia DC soybean futures contract with the contract code as FSOY. Underlying instrument, as mentioned before, it is the crude soybean oil with the quality standards as per the DC soybean futures. The contract unit is 25 metric tons, which is the same as FCPO, BMD's FCPO, which makes the spread strategy very convenient because the ratio is 1:1, very convenient to create the spread strategy between these two contracts, the FSOY and the FCPO. However, do take note that although FSOY is taking DC soybean oil futures as a reference for its final settlement price and the underlying asset, some of its contract specifications are different, especially on the contract unit. DC soybean oil futures is the contract size is smaller at 10, but the FSOY is at 25 metric tons. So if a trader is arbitraging between these two contracts, the FSOY and the DCR East soybean futures, do take note that the contract size is different. So two FSOY contract will be equivalent to 5 DC's contract, as DC's contract is 10 metric ton. So this has to be taken note. Minimum price fluctuation is US dollar 0.25. And the price limit is using the same percentage as DC's contract's price limit. Contract months are the same as DC's contract. It will be January, March, May, July, August, September, November, and December. So these are the months. They are not in the sequence. They are especially, we have, it is all the odd months plus 2 even months, which is August and December. However, do take note that in DCE's market, right, the most active months are January, May, and September contract. So if you are interested in studying how does the current DCE soybean futures work, you may study its trading volume. You may find that the active contract months are always on the January, May, and September. This is how that the contract works currently. As for trading hours, it is also slightly different from DCE's contract. We have FSOY has a slightly longer trading hour, which the morning trading session starts from 9 to 12:30. This is same as the Chinese market, the DCE soybean futures. Afternoon trading session starts from 1:30 until 6. Do take note that DCE's contract close at 3 p.m. but the FSOY trades until 6 p.m. This is to allow traders more opportunities to trade the soybean futures and have more opportunities to price in the soybean oil with trade it with the FCPO contract. So the spread strategies can still be implemented until 6 o'clock. Furthermore, the after hours trading, which is the night trading hours, it is also slightly longer than the DC's contract, which is from 9 to 11:30. DCE's market stops at 11 o'clock at night. So this is some points to take note. And for the final trading day, it settles on the same day as per DC's contract. DC's contract settles at the 10th trading day of the delivery month. So this is something special when it comes to our market jurisdiction. So most of the BMD's existing product, it has a specific calendar day that it expires. But for the FSOY, it is calculated, the final trading day is calculated by 10th trading day of the DCE's trading calendar, 10th trading day of the expiry month itself. This is something new in our market. And if the DCE's 10th trading day is a non-business day in Malaysia, the final trading day of FSOY will be on the preceding day. And on the final trading day, the contract ceases, the contract expires at 3 o'clock, same as DC's contract. As for the settlement method, the FSOY is cash settled based on the final settlement value, which the final settlement price is taken from, is a make reference to DC's contract and convert to the US dollar. Speculative position limit, it is 800 contracts for the spot month and 8,000 contracts for any single contract month or all contract months combined. The trading and clearing fee of the exchange is total at 90 US cents, which 60 US cents is the trading fee and 30 US cents is the clearing fee. Right. So these are the introduction for the FSOY. If you have a further question, please feel free to put it in the Q&A, and we'll take your questions after the webinar. Thank you.
Let's move forward to our next speaker, Mr. Wong Kon Hao started his career as a floor trader in 1995, and later he founded his company Weipedia. His company is engaged by numerous exchange and institutions to develop educational programs. Besides that, his company also provides expert witness and opinion writing services to assist the arbitration process for trading disputes. He has a wealth of specialties in fundamental analysis, behavioral science, and market psychology. Also, he is also an expert in technical analysis, investor profiling, risk management, and investing strategies. Without further ado, I'm pleased to pass the presentation to Kon Hao. Kon Hao, there you go.
Okay, CY, can you happen to check if you could see my screen?
Yeah, your slides is up.
Yeah, okay, that's good.
Yeah.
I think first of all, I want to thank you. Many of you have turned out for tonight's event, and personally, I'm also excited for Malaysia and for Bursa, and I just want to congratulate Bursa in advance that I believe that this is going to be a very successful contract to be. I will give you the reason why. So maybe I just introduce who I am. So I traded widely in different markets. So I'm going to share with you my take, the reason why I believe that this contract is going to be successful. It's not just for Bursa, but also for DCE as well. Okay. Let me just move on to the next slide. So I would just give you a flow of what I'm going to share tonight here. First of all, I will share with you the attributes of this corporation. And then I will talk about for soybean oil, why there's a continuous growth in soybean oil, the reason, and why I felt that this partnership between DCE and as well as Bursa is going to be a successful one. I believe it's going to be a really successful run. I'm going to give you my proposition, the reason why. And later on, we're going to talk specifically on the trading strategy, the long-term investment outlook for commodities as pertaining to soybean oil, and also the very specific trading strategy for soybean oil that I hope to just also give you a key point, what to look out for. And the point of entry for soybean oil if you are a bit more on the short term and even the long term. So followed by the Q&A. So this is what we're going to share tonight, the flow of the my presentation. And so tonight I'm going to share with you the market psychology, or some of you may call the behavior science, where I look into different markets, macro development, geopolitical issue, and how would that impact different commodities, different contracts, different products. So I think that's my expertise. And first of all, I also want to thank Bursa for inviting me to share for this very exciting launch to be. And I personally felt very honored and privileged to be participate in this partnership between DCE and Bursa. So I'm just gonna get started very quickly here. So before that, what I'll be sharing are basically from my own conviction, my personal view. And of course, if you find that what I share is going to be very valid, that you can't wait to get started on the 18th of March, and you go according to what I see, my flow. And of course, what I'm trying to say here is that what I share here is based on my own conviction and for my own consumption, and definitely you will have to consult your licensed broker. All right, let's get started on the first part, where I'm going to share with you what I've read and what I understand about this corporation and why am I feeling so excited here for Bursa and for Malaysia and the rest of Asia or Southeast Asia that near Malaysia, because the rest of the country will also benefit from this corporation. That's what I felt. Now, first of all, I come across this news on the 3rd of November. It's across all different articles. I remember that I think I also saw on the major news article like Bloomberg, all this and that BMD and DCE signed a license agreement for futures pricing. And I'm excited for Malaysia because all this while I knew that China is expanding and DCE is a very huge exchange with record volume trading commodities. And for them to partnership with BMD is a big thing to me for Malaysia and the rest of Southeast Asia here. So when I read this news, I get into the detail, and this is what I know, that's what I read. Let me just get this off here. Okay. Right, so just now we heard and we understood that Malaysia Derivative and Dalian Commodity Exchange have signed this license agreement to settle soybean oil futures. And this will be the first DCE and also first for the Chinese exchange with a pure Asian exchange. This is a first, not for the Chinese exchange, but first for the DCE to go outside of China. So to me, it's a very exciting news for Malaysia. And what's the agreement? Just now Susan mentioned that the agreement is that DCE authorized BND to use the settlement price of DCE, soybean oil futures, as a basis to calculate this cash settlement of FSOY. So it means that there will be a lot of arbitraging opportunities, I'm expecting, between the two FSOY and the DCE soybean oil, and as well as the FSOY and also the palm oil as well. So later on, I'll go into a little bit more on that history. And so therefore, because of the settlement, therefore the FSOY should mirror of that of DCE soybean oil. For those that are not trading the palm oil, soybean oil, what it means here is that because the settlement is agreed upon, whereby at the end of the contract for FSOY, it got to be on the basis of the DCE contract. So what it means that when the contract started, it will have some kind of, by itself, in Malaysian market, of course, foreign participant traders will come in, will make its own price, but they are always mindful that end of the contract, it got to be based on DCE. So it's heading towards the end of the contract. So the pricing is mirror, it cannot be too far off, but yet it will have, the FSOY will have its own dynamic. So the launch date is on 18th of March 2024. Why am I so excited? And I believe that it's going to be a very successful contract for Bursa. It's because of this is the first time China or DCE find a partnership outside of DCE. And because of the at the moment, the current standing is that I aware that Malaysia, there's a lot of traders is trading between the palm oil and DC soybean oil futures over there. So it will bring much more convenience. And for that reason, there's a reason why DCE have chosen Malaysia and Bursa as this partnership. Okay, just finish my introduction. I'm just going to move on. And so there would be definitely a lot of attributes in this cooperation. So the progress for win-win cooperation. When I say progress of win-win cooperation, I'm referring that it is just the beginning, and I believe more to come in the future. Of course, all these are based on my view. It's not from Bursa. So I just want to share with you personally how excited I am for Bursa. Now, let me just explain to you when a product or similar product is launched in two exchange, there's certain attributes to it. What are the attributes to it? I'm going to do a comparison between the soybean oil in DCE and also a comparison between with the US or CBOT soybean oil. What are the attributes? And then I'm going to move into between DCE and FSOY later on. Now, so for the attributes, so what you could see on the left is the DCE soybean oil, and on my right is the CBOT soybean oil. So now the US soybean oil have a long history, and as much as my trading view can capture, it started in 1970s, during the 70s. So, but I'm going to mirror this with when DCE soybean oil started, and that was in 2006. Yeah, so we could see that how it mirror between the two. So basically, when a product lists in two exchange, what it does, what's the attribute is that I think the most important thing is the price discovery. So having a same product or similar product listed in two exchange, of course, different exchange will have their dynamics. But for the physical trader or the enterprise, when you use the commodity prices as a hedge or a basis of the price, then there's a comparison. So it's always good to have a price, a product price in two different exchange. So the enterprise or the physical trader will have a comparison, a price discovery. So instead of having one, so you combine the call, but if you have two, then there's a comparison and it will mitigate the price. So you're going to bring attributes to not just the physical trader, but the end consumer as well. But having a product that listed in two exchange, the other attributes are arbitraging. What is arbitraging? Means that spread trading opportunity. They are not the same, but similar when you move along the timeline together. Of course, certain product will move off alignment, but at the end of it, it should come into alignment again. But in between, there'll be some spread trading opportunity. There'll be some arbitraging opportunity as well. But of course, for the risk, what I'm referring here is hedging. So enterprise may use the futures to hedge into the risk. And then we're gonna, with a product to have two exchange, it's definitely going to increase market participants. Say, for example, if you have not traded soybean oil in the past, because that was in DCE, that was in CBOT, but on the 18th of March, Bursa is going to have the FSOY. So the first time you're going to expand your trading portfolio into soybean oil. So in a way that is also increased market participation as well. So with currently, just do a comparison attributes of having a product listed in different exchange. The other attribute is a different time zone. So for this example is quite good because one is in the Western time zone and the other one is in the Asia time zone, comparing between DCE and CBOT. So it kind of have a 24/7, it coverage a wider time zone for enterprise traders to hedge or trade into their contract. So now I just want to look into this comparison between DCE, soybean oil, and CBOT soybean oil. Then I will go into the FSOY and DCE soybean oil. Now, so it started in 2006. That's where DCE soybean oil launched. But I want to see that the dynamic at a point in time for DCE, it was, what can you see here is that my observation here is that it could be because of the newly launched in 2006. So I think for the China market, the DCE soybean oil is, they are discovering the prices. So it got a little bit volatile. So you could see that in the same period, from the trough to the peak, the DCE soybean oil expanded by 240%. Whereas for the CBOT soybean oil, it was up 193%. Now, as the timeline flows, you could see that the movement became more aligned. So it make arbitraging a little bit more feasible. It's not so risky. So traders able to get into both contract to arbitrage to spread trade them. Now, let's look into what happened to the recent years. And I make an observation of 2013. So later on, I'm going to explain to you why there's this 2013, the development. As time passed, where you could see that somewhere around this period, 2009, the DCE soybean oil and the CBOT soybean oil is come into better alignment. So this trend continue, which is good for arbitrager. It continued into even to 2013, even to before COVID-19, before the pandemic. So it kind of is a good two contracts, different exchange, and we have a good arbitraging opportunity back then. But 2013 and onwards, something have shifted a little bit. Yeah, what I'm seeing here is that where we could see that my study is that the CBOT soybean oil has been getting a little bit more volatile compared to DCE soybean oil. Now, how do I determine whether the contract is more volatile compared to the other? Is this. When the market dropped, it dropped more than the other. And if the market move up, it move up more than the other. So then I will classify that this contract is more volatile than the other, especially in the same or similar product here. And why is this important? Because when the for physical trader, for enterprise, they do not like volatility. When volatility is too fast, too quick in a very short period of time, it's very difficult to adjust into it. The important thing is that as market move, it got to be trendy. Now, as COVID-19 hit in 2020, and that's what I'm seeing here is that I want to do a comparison between the DCE soybean oil and the CBOT soybean oil here, is that the CBOT soybean oil, it got much more volatile. So what you could see, I hope that you're seeing the cursor here, is that the price became much more volatile. So it could make the arbitrager or spreader a bit more risky because the price differential is too great, too sudden, too quick. But it's always good that as the move align in together is have this very close aligned relationship. Now, so what happened here is that when 2020 hit, and what we could see here is that the relationship kind of shifted. The US soybean oil became much more volatile. And we could see that from the trough to the peak, during the peak of the COVID-19, the CBOT soybean oil went up by 255%, and whereas the DCE soybean oil is only up by 161%. So as the lockdown is over and business back to as usual, and therefore the supply chain get to normal again, the commodity prices also start to come down as well. So what we could see here as the market come down, the CBOT prices come down by 49%, and the DCE soybean oil prices is only down by 46%. And you could see that the recent low, which is today, that the market start to break the previous low, whereas the DCE prices still hover around this retracement. Now, so then we have to examine what is the cause of this deviation in volatility. So in the past, it was before 2013, especially, that's my observation here, is that the DCE and soybean oil, the CBOT has been moving in alignment, pretty much alignment together. But I observed that especially in 2013 and onwards, the CBOT soybean oil has get a little bit much more volatile compared to the DCE soybean oil. And this again, I would say that the enterprise or the physical trader do not quite like this, because can you imagine that we have this DCE soybean oil prices that we benchmark on, then we also reference to the CBOT soybean oil. But at this particular point, that the soybean oil for CBOT is much higher. So where do we take reference on? So in a way, I would find that it's very difficult for the enterprise or physical trader to find a balance where the pricing should be. But what is the cause of this deviation in volatility since 2013. So that's my view and that's my observation. I felt that is because of dollar yuan. So what I could see here is that there's this liberalization of the yuan. Now, what's the impact to the soybean market, which I'm going to explain in a short while later. Now, especially after 2013, I felt that based on this observation, there's the liberalization of the yuan. And why I say so? Because when we study into the price behavior observation, this is what I see. When the price is this way, it means that the price are very much, the dollar yuan are very much into scrutinies, I would say that. Yeah. But when it start to open a tab, which is a good thing, the liberalization of yuan, how do I know that? Because on the price behavior, we could see that instead of a very stagnated movement on the dollar yuan, it kind of moved into better swing. They're based on the supply demand of dollar and yuan. The market, the currency went into a better swing based on supply and demand. Now, let me explain to you what is the liberalization of the yuan. It means that is loosening the restriction on currency conversion, allowing the yuan to float more freely in the foreign exchange market and expanding its use in international transaction. I would say that businesses, physical traders, enterprise like this liberalization of yuan. It brings more fairness to the market, the commodities that they're trading in. Now, so on this chart, we kind of agreed upon that 2013, it was the liberalization of the yuan. And I do suspect that it started somewhere around 2010. But somewhere around 2013, we could see that the dollar yuan start to get a little bit more volatile, which is a good thing. Then, of course, at this point in time is that the yuan is weakening against the US dollars, that you may say that then that's no good for DCE soybean oil, because as the yuan get a little bit weaker, the DCE soybean oil will price higher. But I think that's beside the point. What I'm trying to point to you here is that based on this analysis, we could see that there is a liberation. Let's just go back to 2013 again. And we could see that from 2013, we could see that if I'm going to compare to DCE soybean oil and CBOT soybean oil, we could see that the CBT or rather DCE soybean oil is not as volatile compared to CBOT soybean oil. Not as volatile. So of course, based on the commodity supply and demand, it will still move in trend. But we could see that CBOT soybean oil in the recent years have got a little bit much more volatile compared to DCE soybean oil. And the physical trader or enterprise do not quite like that. Now, so the next question is this, that will yuan continue to liberalize? And of course, my answer is yes, yuan will continue to liberalize. It also means that the DCE soybean oil will continue to be at play based on supply demand. Market will continue to trend up or down, but in a smoother manner than getting much more volatile. That's what I'm trying to say here, which is may not be a bad thing. It can be a good thing for the arbitrager and the spreader. Just on a side note, as I prepare this presentation, that I'm also aware that Bursa Malaysia have launched this mini dollar yuan, offshore yuan futures contract last year in December, if I understand it correctly. So for those that are interested to trade, the mini dollar offshore yuan is available at home here. Now let's continue to discover about the price discovery here. Now, the win-win cooperation for between the DCE soybean oil and the FSOY. FSOY, I'm referring to the 18th of March, where Bursa is going to launch the FSOY. Now, because of the context of the settlement price have to be based on DCE, so every time new contract launch, the FSOY will have its own dynamic, movement. But towards the end of the contract, it will have to base on the settlement price of the DCE soybean oil. So in a way that the market will be moved in alignment a bit more, and that will help the market to have a better price discovery comparing to DCE soybean oil and CBOT soybean oil. But now there's another player coming in, which is the FSOY. So the DCE soybean oil and the FSOY is going to have a better comparison and better price discovery. Now, let me just move on to the next slide, which I find is real interesting that you may want to take note of. The other one is the arbitraging trading opportunity. Now, so I do aware that in Malaysia, there's a lot of traders trading between the palm oil and DCE soybean oil. They're doing spreading. So what is spreading? It means that we could see that one is the yellow line is the palm oil, and the orange line is the soybean oil. And it's a different product, but very similar product. And just like just now what Susan said, that both palm oil and soybean oil are substitute of many applications. So you could see that in the longer run, it moves in quite in tandem together. At this moment, that based on what I understood, is that there's a lot of spreader between the Malaysia palm oil and DC soybean oil. So they are doing the spreading. But coming on the 18th March, where we have the launch of the FSOY, then I think the Malaysia traders do not have to go to DCE. Of course, if you want, they can continue to do that. There's an opportunity for you to trade FCPO, the palm oil, and the FSOY Bursa down here. Now, because of these two contracts are in the same exchange, which is Bursa, then therefore you can enjoy a margin credit. So do check out with Bursa and also your broker how it functions. And of course, not forgetting that there's an opportunity to spread between the FSOY and also the DCE soybean oil in DCE itself. So these are the attributes when there's a contract launch in two different exchanges. These are the attributes, and of course, there's much more: price discovery, arbitration, and risk and trading. You also increase the market participation, and of course, in terms of the trading hours and different time zone, is not much different. Now, let me just move on to the next topic here, where later I'm going to share with you some of my long-term outlook for soybean oil and some very direct trading strategy, what to look out for the soybean oil very shortly. Now, let's look at the usage of soybean oil. Of course, we know that the soybean oil, there's a use for food industry, including food process, non-food application as well, biodiesel, lubricants, paint, and etc. Healthcare, personal care product, and many more. Now, next thing I'm just going to point to you here is that the domestic consumption of the soybean oil worldwide. Who is the one that consumes the most soybean worldwide? It is China, then followed by United States, Brazil, India, Argentina. So China have the appetite to consume the most soybean oil in the world almost many years by now. And then the next question is that, do China produce soybean oil? Now, we're going to see the next slide here is that on the 2022 and 2023 numbers, China is also one of the largest producer of soybean oil, followed by US, Brazil, and Argentina. And China consume the most, but they also produce the most. But they consume, at this point in time, more than they produce. So what they do is that the Chinese still also continue to buy from their trading partners, from Argentina, from Brazil, and some from US as well. They continue to make purchase because their own production, it is not good, it's not enough for their own consumption. So therefore, soybean oil or soybean is important commodities and access for China market. Now, so this is how important China, soybean oil, and China. Now, next one is that, let me explain to you the use of soybean oil or soybean. Of course, soybean oil comes from soybean. It's being crushed to oil. And what's crushed, the byproduct are soybean meal. Now, soybean meals are used for animal feeds. And then the byproduct is also soybean oil. Now, so my question to you is that, is soybean meal and soybean oil demand will continue to grow? And you may say that, Kon Hao, because the China population is decreasing, and that's your concern, that soybean oil may not be in demand as much as before. Not exactly, where I do agree that the population may be declining, but you also have to understand this, that for China, their GDP per capita is growing. What do I mean by that? It means that the people are getting richer by days, by weeks. So you have to understand here is that when people are getting richer, they consume more, they purchase more. So the middle class of China market are getting richer. And when they buy or eat more meat, the soybean meals are the animal feed as well. So the soybean meal compared to the three, soybean meal in the commodity market are the most traded product in between the three, followed by soybean oil and followed by the soybean market. So I believe that the China market will continue to consume a lot for soybean oil. Now the next question is that why soybean oil or DCE have chosen Bursa to have this FSOY to be listed on 18 March. One of the attributes that I really know is that I know that a lot of Malaysia friends and traders are already trading between the palm oil and the DCE soybean oil. So it's very natural that that's why earlier I say that I believe that this launch is going to be a very successful product for Bursa. So it's a natural transition that when FSOY is being traded, the Malaysia traders and maybe the China trader and outside of Bursa or Malaysia trader will also look at between CPO and also FSOY as a spread market. Another point here is that the DCE soybean oil is traded, those soybean oil is traded in DCE are mainly by enterprise, about 90%. I cannot be specific the percentage. And again, that in the recent years, the progression, we could see that the China market do not like too much of speculation. So earlier we do a comparison between the DCE soybean price and the CBOT soybean price. So when these two markets in comparison in the recent years, we also saw that the CBOT soybean price is getting much more too volatile, which I suspect that the China government do not like that, because I believe that they prefer a price that is based on pure supply and demand, but not on speculation. Why? Because the DCE soybean oil is traded mainly by the enterprise. And the last point here is that they will identify that BMD is a good match for expanding across border price discovery. So earlier I also mentioned that this is good news for Malaysia, good news for Bursa, but it's also good news for the rest of the ASEAN country as well. Because I believe that when Malaysia prosper, the rest of the Asia country will prosper as well. Now, let me just give you a long-term outlook for this soybean oil. So what is the long-term outlook of soybean oil? And very quickly, I just want you to follow me to look at these three contracts, which is the soybean meal, and soybean oil. Now, based on what you see, I want to share, maybe we're not able to interact at this point in time, but maybe from when I flip the three long-term chart, I want you to align your thoughts to look at where is the long-term trend for these three contracts, which is the soybean oil, and soybean meal. Now, what's the long-term trend for soybean market? Now, first of all is the soybean that I prepared this chart since somewhere around 1969. So visually, what can you see? What do you see in the long-term trend for soybean market, which I'm going to give you my analysis in a short while. So what's your long-term analysis in the soybean meal market? And what's your analysis for the soybean oil market? Now, so I'm going to present to you a technical reason, and later on I'm going to describe to you the fundamental reason why soybean meal, and soybean oil seems to be moving on the uptrend on the long-term horizon. Now, let's look at the soybean market first. If I'm going to draw a trend line together, basically how I draw a trend line, I have one rule, in fact, two rules. The two rule is that first I have to find at least three significant trough. So I found 1, 2, 3, maybe about 4 or 5 here. And the second rule is that I try to join them together. So if I have 3 significant troughs, if I'm able to, you just make some adjustment, able to align them together, I will classify this as a primary trend. Now, usually for a primary trend, I will continue to develop because market develop. I'll continue to develop my view, and usually also come with a secondary uptrend line. So secondary uptrend line, the starting point is the trough. I could see that I joined a second point, maybe third, fourth, 5. So the rule number 1 is that I have to find at least 3 significant troughs, but I found quite a few. 1, 2, 3, 4, 5, 6, 7. So I would say that this secondary uptrend line is, I'm going to use it definitely along the timeline. It means that as the market continue to retrace, I'll definitely looking out for somewhere around this 1,000 level that you're seeing here. So of course, this secondary uptrend line, it may also develop in as a primary down uptrend line. Then I'll further develop this to find where is the next secondary uptrend line. So this soybean oil, and look at soybean meal here. That I could see that there's this secondary uptrend line in soybean meal. So again, we could see that there are 3 significant troughs. In fact, a few, if you join them together. So the 2 rules are, first rule, you have to find at least 3 significant troughs. And second rule is that we try to find the alignment. Means that you make adjustment until you find that it fit very nicely. I will use this as a secondary uptrend line. So this will be helpful for me to track the direction of the soybean meal. Now let's look at the next one, the soybean oil. So this is soybean oil, and this is what I reckon for the secondary uptrend line for soybean oil. And how about palm oil? So this is my view for the palm oil. As you could see that this is my view for the palm oil in the secondary uptrend line. Now, then you got to ask me, why is there this, my view for the long-term uptrend line for commodities up? Let me just share with you another chart that I explained to you is because of the inflation. Now, if we compare all these commodities, from oil to crude oil to soybean oil to palm oil, meat, cattle, soybean meal to rice, I'm going to do a comparison since COVID-19 days until today. Now, I always reference inflation with gold. And as long as gold continue to trend, my position or my proposition is that the rest of the commodity, based on its own season and timing, it will also follow. Yeah, so as of now, commodity last night for gold continue to move up. Now, let me explain to you about inflation here is that, of course, the recent inflation for January number for US is at 3.1. In June 2022, the inflation number was at 9%. So the inflation have dropped. But before the inflation started to pick up to 9%, that was about 3 years ago, inflation was at about 2%. And the central bank over that period and way before has been mentioning that inflation, they target to be 2% every year. Now, why they target 2% is very simple reason, because of the printing of money. As long as the money supply keep on moving, there'll be a dilution of certain currency. When currency is being diluted, inflation will pick up. But over the years, over the decades, different central bank has been emphasizing that they want to see inflation at 2%. It means that they know that inflation will come, but they have to manage it very carefully, not to let it rise to 9%. As we could see in June 2022, it rise to 9%. And the central bank, of course, do not like it. But based on this money supply over the years, because of dilution of currencies, inflation will pick up. And that's what we see here, that earlier let me just backtrack. Palm oil was seeing this general uptrend line. Soybean oil was seeing all this general uptrend line. And so is soybean meal. Okay, let me just go back again that as long as there's inflation, and inflation will always be there, how I measure this is that I was keeping track of the gold market. As long as gold market remain high And I believe that if you could see that since the COVID, the crude oil has been going up, it retraced. So is palm oil. It's been going up, but it's retraced. But compared to crude oil or the COVID period, the market are generally still higher. And we could see that rice is moving up and the meat are moving up as well. Now let's look at my trading strategy for the short term for the soybean oil. So earlier I mentioned that I hope that I can offer you a very practical and what I'm looking at in maybe days or weeks to come, how I'm going to time myself to get into the soybean oil market when that happens. Now, the trading strategy for short-term trading is that, so earlier I mentioned about the long-term outlook because of inflation, where I believe most of the commodities will continue to trend up. So what happened that over the last 1.5 years that commodity came down is because of the opening up, because of the lockdown, the supply chain have resumed, and therefore the commodity price, much of them have started to ease off. But I believe that the commodity price will start to move up again. So I'm going to share with you the timing that I'm looking at. Hopefully that will be useful for you. So this is a DCE soybean oil, and we're looking at a weekly chart here. So I'm going to apply very technical reason. So later on, I'm going to also explain to you the macro fundamental development of what I'm seeing here. Now, of course, from the year 2020, we know that because of COVID, almost all the commodity prices has moved up. So we know what's the fundamental reason. Now, I'm going to apply what we have learned earlier about how to draw a trend line. So on the uptrend line, we look at least 3 significant troughs. So I saw 1, I saw 2, I saw 3, I saw 4, I saw 5. So rule number 2 is that when we saw all this significant trough, we try to join them together. We make some adjustment, and I find that this adjustment is good. Now, so when we have gathered this alignment, this uptrend line, the thing is that we have to first identify if this is going to be a classic uptrend line. Now, I would say that this could be a classic uptrend line. Why? Because it fit into at least 3 significant troughs. So now the rule is that it cannot break below technically. So if we break below, it means that I'm interested to sell into strength. So of course, when we look at the fundamental reason, that was a period where most of the lockdown most of the activities have resumed after the lockdown of the COVID-19, and it has developed into a downtrend line. So when it developed into a downtrend line, as a trader, my strategy is always to focus on sell into strength. So the key is that when you see fundamentally and technically the whole trend has developed into a downtrend line, and the strategy is always that my focus is to sell into strength. Now, when I say focus, is that means I try my best to sell into strength. I try not to buy and sell both sides. That doesn't mean that I would not buy. It means that I try to gather much of my resources, my energy, my analysis into finding where and when to sell into strength. Now, the next strategy here is that I believe that inflation is not over yet, and inflation should pick up. So later on, I'm going to give you the fundamental reason why. So as I draw the downtrend line, so what are the rules to draw a downtrend line? The rules are the reverse. So on the uptrend line, I look for at least 3 significant troughs. So on the downtrend line, I will look for at least 3 significant peaks. So as I draw this DCE soybean oil on the weekly chart, I could identify 1 significant peaks, 2, 3. Now I have to do some alignment, and as it develops along the timeline, we have to make some adjustment. So, but at this point in time, I will classify that this downtrend line is pretty classic. Means that it is usable. I will continue to look at it day by day, week by week, until it starts to break above this downtrend line. Then I will know technically what to do. But it also have to confirm with the fundamental analysis. So what I'm waiting for here is that once it starts to break above this downtrend line, technically I'm seeing that there's a reversal in trend. This downtrend line for soybean oil, DCE soybean oil, may transit to an uptrend in time to come. But it must also align with some fundamental development. Now, when this happened, my strategy is to buy into dips. I will focus to buy into dips, but that doesn't mean that I will not sell. I will still sell when opportunity is, but the focus will be buy into dips. So it's just like earlier when the market, the DCE soybean oil, broke this uptrend line, the focus is to sell into strength. Now, so what is the possibility that this may happen? So I'm just going to give you a little bit of more precision, not just technical, but some fundamental development as well. Now, the fundamental development is here, is that, let me just help to recall what happened to 2020. Of course, all of us know is because of the pandemic. We have lockdown, not just in Malaysia, all over the world, we have lockdown. And that caused a disruption in the supply chain, and that was 2020. And we all experienced, just now I showed the earlier chart, that most commodity prices went up, and that led the US to have this inflation in June 2022 to 9%. There's a delay effect. Because of COVID-19, it caused a disruption in the supply chain, and things become much expensive. Yeah. So now let's look at what happened in the recent months of development. Since about December last year, we have this Red Sea crisis. I think you know what's happening here is that the Houthis harass the vessel. And let me just explain a little bit here about the importance of this development that may cause commodity prices, it's not just in soybean oil, but commodity prices to transit from a downtrend that we're seeing and perhaps into an uptrend. So what happened here is that on the right side, of course, are Asia. So Asia, we export our product to Europe through this channel called the Red Sea into the Suez Canal. Yeah. Now, because of the Houthis harassment in the Red Sea, so a lot of vessels have choose to route, instead of going through, they have no choice but to route around South Africa through the Cape of Hope port in South Africa and move their goods to Europe. So similarly for export from Europe to Asia is going to take this route. More than about 50% of the vessels have chosen this route now. Now you have to understand that instead of taking the export to transport to this Red Sea, to this canal to Europe, it's a shortcut, but now most of the vessels have to go by this route. And what I understand here is that every vessel are paying, just on this route, every vessel, depending on their size, are paying a few $100,000 extra just by taking this route. And again, there will be a delay effect that, of course, this was translated down to shipment became expensive, porting became more expensive, and this will translate down to the end consumer paying a higher price in time to come. There's always this delay effect. So this geopolitical tension that I'm seeing here is still expanding. As I check as of this afternoon, as I read the news, this Red Sea crisis is not over yet. It's still ongoing. And that may also lead to a U-turn in inflation. And what we are looking at here is that, of course, we know that inflation for US, the highest point was in June 2022, was 9%. As it come down to June last year, it hit a low of 3.1%. But over the span of last many months, it has been hovering at about 3%. And why the stock market was a bit jittery the last few days, it was because of investors are getting frustrated that inflation is not coming down to 2%. It seems like it's hovering around 3%. And they're also quite fearful that could this cause a U-turn in inflation and move up again. So if that happened, and what I felt that, so we also have to time it with the macro development as well. So what I'm seeing here, that this is one key point. And just a recap here, how to get the timing into getting into the soybean oil in the next few weeks to come, because we're looking at the weekly chart. So again, let me just recap is that this, what we've drawn is a classic downtrend line. And along the timeline, please help yourself to make adjustment technically. Now, as if this get worse, it could be these variables. If it get worse, inflation across is not just soybean oil, will start to move up. Now, if it move up, it broke above this downtrend line. So technically, I know that the play in coming weeks or months to come for soybean oil, it will be pretty straightforward. My focus, it will be buying on dips for soybean oil. So I hope that you enjoy what I just shared. And I think now we move into the time of Q&A regarding the contract specs related. I think the Bursa will be in better position to address you. And just to leave you some contact point here. So I have this YouTube channel. I have this playlist. You can view it for free, where I have a series called the trading strategy. So I describe not all of them what I described here tonight. You can visit that. You are able to have a full suite of what I know. And the website is weipedia.com. And of course, feel free to email me if you have any thoughts of what I shared tonight. So maybe I just pass this time to the organizer for the Q&A session.
Thank you, Kok Kao, for your informative sharing. I believe many of our audiences here have gained valuable information about how to take advantage of the opportunities in trading the FSOY, the DCE soybean oil futures in Malaysia. Now it's time for our Q&A session, and I encourage you to participate by asking any questions that you may have. And to do so, simply type your questions in the Q&A box. And to ensure that your questions are seen, when you submit your question, please make sure that you send it to the Q&A box and ensure that I am able to easily locate and address your questions. And while waiting for your questions to come in, for those of you, if you don't have any questions, I would like to ask a small favor from you. I would like you to take a quick 1 minute of your time to fill up this feedback form, since we have already provided you an informative session for today. So it just only takes you less than 1 minute to fill up this feedback form. You can pick up your smartphone to scan this QR code. So just take 1 quick minute, let us know your feedback. So here I'm going to give you 1 minute to complete the form, and we will begin with the Q&A soon. Another 30 seconds to go. Alright, if you have already submitted your feedback, I appreciate it. Thanks a lot. Well, for those who haven't finished yet, you can continue to finish to complete the feedback form, and thanks for your participation in giving us your valuable feedback. Now let's continue with the Q&A session, and to ensure we have sufficient time for all questions, we will be selecting and answering the most relevant questions from the Q&A box. And please note that due to time constraints and limitations, we may not be able to pick up and answer all of the questions. So here I see there are some questions that is related to contract specifications, and some that is for Susan, and some questions that is more related to the trading strategies for Kon Hao. So I will address some of the questions that's related to contract specification first. So for Susan, the first question is tentatively, what would be the margin requirement for trading FSOY?
Hi, CY. Yeah, the margin for FSOY will be out about 1 week before the product launch. So product launch is on 18 March. The actual margin will be out on about 11 March. But the estimated margin requirement will be about 5 to 8% of the contract value, which is about roughly $1,005 per contract.
All right. And the next question is also for Susan. Whether is FSOY Sharia compliant?
Right. To be Sharia compliant is what I understand. It will be. It has to be a physically delivered contract. But FSOY is cash settled, so yeah, we wouldn't say it is Sharia compliant at the moment.
All right. And another similar question as well regarding contract specification. Whether there is a span margining for trading inter-commodity spread between FCPO and FSOY.
Oh yeah, both the FCPO, all the BMD products will use span margining system. So I believe what you're talking about is margin credit. So if you're trading, yes, we will have some margin credit for this two contracts, the spread strategies for these two contracts. But when a product is new, we wouldn't expect too much of a credit for this kind of strategy, but there will be.
All right. And I see there's a question that is related to the FSOY fundamentals. I think it's more related to Kuan Hao. So the first question would be, what is the correlation of soybean oil and crude palm oil? Kuan Hao, your mic is mute. Can you switch it on?
Okay, maybe what just now Susan can back me on this, because I think just now Susan, before I start, he gave a quite a good slide, one of the slide where there's one key point here that she mentioned both palm oil and soybean oil are substitute in many applications. So perhaps Susan, you may want to tell us what are the many applications like. So earlier, what I do a comparison, if I'm not too sure if I can share with you the chart here, is that I show a comparison between the palm oil and the soybean oil over a period of I think since when was that? Maybe what I should do is that let me just share the slides again, if it's possible.
Okay, yeah, sure.
Okay, so what you're seeing here is that unfortunately the trading view that I have, they don't have the DCE soybean oil. So this is based on soybean oil, CBOT, and the palm oil. So your question is that what's the relationship between palm oil and soybean oil? But if we could see the relationship since about 1993, it moved in alignment together, pretty much together. But of course, in between, there'll be some deviation or this and that. So earlier mentioned by, so this could be some spreading trading opportunity, but also very keen to find out from Susan, earlier mentioned about palm oil and soybean oil are substitute of many applications. So what are the applications that you know? But based on this, unfortunately, I'm able to get the relationship between the DCE soybean oil, which I felt that it could be quite similar compared to DCE soybean oil and then palm oil. So personally, I was so very excited. So the question I do not know, but I'm going to wait for the market to start trading to make an observation to give you a better clarity. What is the difference between the palm oil and soybean oil? But based on the past history, that what you could see that it moved in tandem together. But in different period, the spread became wider. So I think it's so good to understand about the similarity. Maybe I do not know whether Susan want to take on this question. The similarity between the many application, what are they?
Yeah, maybe I can add on the correlation. Yeah, it will be the correlation between the FCPO and the DCE soybean oil. You can get the DCE's either is DCE's daily data either online or from this information vendors, Bloomberg, Reuters, Refinitiv. So according to what we count, using the daily prices of 2023, it is close to 90% correlation for FCPO and DCE Soybean futures. So it is pretty high, and it shows that it moves in tandem and is a very good combination for spread strategy.
All right, great. So it seems like FCPO and the FSOY moves quite, both of them has quite a strong positive correlation in that. All right, the next question is for Kon Hao, is that what are the factors typically that influence the price movement of DCE soybean oil futures?
I think it's a very good question. So on not just soybean futures, but it will also depends on the supply demand. I think the basis for all commodities are based on supply demand. So we have to look at the current supply or demand. Demand is usually pretty consistent, but it's always a supply. So once we understand about the supply demand, is that if supply is lesser than the demand, the continuous demand, usually the price will start to shoot up. So we also have to look at the harvest period for China, where the harvest period in China, Argentina, and Brazil are quite similar, somewhere towards the third quarter of the year. But if the Argentina and Brazil also have bumper harvest, it means that there's more supply than demand, and then that will cause the price to come down, because demand is always there, but if supply also in abundance, then the price naturally will come down. So we have to keep track of all the supply and demand issue. But the other thing that earlier I mentioned, that what I look at is because personally I trade across different products and not just soybean oil. For commodities, my feel and my gut feel is that based on what I shared earlier, so basically I do not get into the detail, the micro detail of the specific product. So my strategy here is that I always look at the macro development. So earlier, the macro development is that my concern is that the Red Sea crisis may get worsened. And you may not feel it too much right now because there's always a delay effect to come into the inflation at play, where I think the physical trader are actually paying much higher costs. This will translate down to more costs for the end consumer. So we will felt it much later. So with the ongoing of the Red Sea crisis, I believe that all these commodity prices, include the soybean prices, will pick up. So as it start to pick up, my strategy is just based on the price behavior to buy into dips. Of course, earlier I mentioned I'm more towards the commodity supply demand, which is also as important. So that will help you to get into the specific retracement as it comes then and then.
All right, thank you, Susan and Kon Hao. I don't see any other questions coming in. So it's about time, and allow me to wrap up for today's webinar session. Now, I noticed that there are many new traders here, and before starting to trade FSOY contract, you need to learn the basics of futures trading first. And starting next week, Tuesday, we will begin with the LLF Let's Learn Futures webinar series, which is brought to you by Bursa Malaysia. You can pick up your phone and take a picture or snapshot of this page and register yourself right after this webinar ends. And once you scan the QR code, you can come to this page, and there will be an event calendar. So each and every Tuesday, we will be having this LLF webinar series that will be conducted in 3 languages: English, Malay, and Mandarin. And we have exciting upcoming topics where our panel of speakers will be sharing with you insightful knowledge and practical strategies related to futures trading. So if you would like to join the upcoming sessions, you can find the LLF webinar topics on the Tuesday column. You can click on it and register yourself. Besides that, we also have the online workshop, also brought to you by Bursa Malaysia. This is perfect and suitable for you if you are still very new to futures market and futures trading. And I highly recommend you to join this free online workshop. If you want to understand the futures market and learn how to trade futures in detail, then this online workshop is definitely right for you. This online workshop will cover all of the basics and fundamentals of futures trading you need to know before you trade futures. So basically speaking, it is the step-by-step workshop where we will be guiding you how to kickstart to trade your first futures contract from A to Z for all beginners. You can pick up your phone and take a picture or screenshot this page and register yourself right after this webinar ends. It's only for those who are serious in starting a futures trading, because each and every session we will be limited to the first 50 online attendees only. Besides that, you can also find this online workshop in our event calendar as well on the Saturday column. So this online workshop usually falls on the weekends. All right, this comes to the end of our webinar session for today. Thank you, Susan and Konhao, for sharing with us an informative session. And thank you all for joining us today. We hope you found this webinar informative and engaging. And I believe you have learned lots of informative knowledge and broadened your perspective about the new FSOY futures contract, the Bursa Malaysia DCE soybean oil futures. So with that, I'm CY. I'll see you next time. Good night and goodbye.